Stop what you're doing for a second, because gold and silver just pulled off the kind of move that usually only shows up right before the crowd realizes they've been asleep at the wheel. I'm John AG, and today's wrap is going to be straight to the point. New record highs, violent swings, and the kind of blink and you miss it price action that separates people who are prepared from people who are about to buy the top out of panic. On the surface, it looked simple. A huge surge at the start of the week, then some pullbacks, then a messy finish. But underneath that surface is where the real story is hiding, and if you miss it, you'll misread what comes next. Because here's the weird part. The volatility didn't happen at cheap prices. The volatility happened at insane prices, and that matters. Gold ripped higher early in the week and tagged a fresh all-time high in the mid-4600s. Silver didn't just follow. Silver tried to steal the whole show, pushing above the low 90s. For a moment, it felt like the market was reminding everyone that when silver moves, it doesn't knock on the door. It kicks it in. And yes, by the end of the week, we cooled off. Gold drifted back under $4,600, and silver backed off from the intraday fireworks and settled around the $90 area. But I want you to hear this clearly. Backing off after breaking out is not the same thing as breaking down. If you're waiting for the perfect dip, you might end up doing what most people do in big cycles. Watch the train leave the station, then sprint after it, then blame the market when you slip on the platform. So today I'm going to do three things. First, we'll break down what actually happened this week in gold and silver, where the pressure showed up, where the buyers stepped in, and why that ugly intraday selling didn't change the bigger picture. Second, we'll talk about why the mining stocks are still acting like they don't understand what's happening, and why that mismatch can turn into opportunity if you're patient and you're positioned. Third, we'll connect the dots to the stuff most people ignore: rates, inflation data, bond stress overseas, and the political noise that keeps pushing the world toward hard money, whether policymakers want that outcome or not. And then, at the end, I'm going to ask you two questions that I genuinely want you to answer in the comments, because your answers will guide what I focus on next. Now, quick housekeeping before we jump in. My channel stats show something that honestly drives me a little crazy. Most of the people who watch these videos are not subscribed. I'm not saying that to guilt you, just being real. If you're getting even a little bit of value out of this, hit subscribe. We're pushing hard to reach 50,000 subscribers in the next 30 days, and your click is the difference between this channel staying small and this channel becoming a daily resource for people who actually want to understand money. Also, we're now posting members-exclusive videos on a regular basis, and this isn't recycled content. A dedicated team is working behind the scenes to build these deep dive updates only for you, our special members, and the John AG family. If you want in, click the join button right now or use the link in the description. All right. Let's get into it. The headline is easy: record highs. The part that matters is how we got there. We had a surge that started before the week even felt like it officially began. You know that feeling when the market opens and it's already gone? That's what this was. The kind of jump where, by the time a normal person checks their app, the move has already happened, and the only thing left is the regret. Gold was up triple digits at one point early in the week, one of the biggest single-day dollar rallies I can remember seeing. Silver was up multiple dollars in a flash. Not just up like it was trying to remind everyone that it's the more emotional cousin in the precious metals family. Then, of course, we got the reality check day. The kind of day where the market shakes the tree to see how many weak hands fall out. Silver got smacked hard intraday, down several dollars at its worst point. Gold dropped sharply as well, down dozens of dollars from the highs. And if you only looked at those candles, you could convince yourself the party was over. But by the close, the damage was smaller than the panic made it feel. Gold recovered most of the intraday loss. Silver clawed back a big chunk too. So what happened? This is where people get tricked. When you're in a real breakout, the market doesn't move in a polite straight line. It moves like a crowd in a stadium. Surge forward, step back, surge again. The step back isn't always weakness. Sometimes it's just the market checking whether the breakout level is real. And look, I'm not here to pretend pullbacks don't happen. They do. But the mentality that says, "I'll just wait for cheap silver again," is a mentality built on a past that may not come back. Here's the brutal truth. The window for bargain pricing doesn't stay open forever. And the longer a trend matures, the less likely you are to get your dream entry. If silver ever prints a number with a 5 at the front again, it would likely take the kind of crisis that makes people forget they even wanted silver in the first place. People don't buy cheap in a crisis. They freeze. Then they buy expensive later when the fear turns into headlines. So if you're trying to get positioned, the question isn't, will it dip? The question is, what happens if it doesn't dip the way I want and I'm sitting in cash watching it go? Now let's talk about something that's been irritating me, and if you've been watching this channel, you know I'm consistent about this. The mining stocks are still not priced like they believe these metals are here to stay. You would think that with gold around $4,600 and silver near $90, mining businesses would be getting treated like cash machines. Because if your revenue line explodes while a huge portion of your cost base moves slower, your margins can expand fast. Instead, what do we see? We see mining stocks that get punished on days when metals dip even a little, like the market is still convinced the metals are about to crash back to normal. And what is normal, by the way? Normal is a story people tell themselves because the truth is uncomfortable. The truth is, if gold and silver are breaking out because of monetary stress, then the environment that created the breakout doesn't disappear just because the price wobbles for a day. In fact, the kind of intraday sell-off we saw is exactly what big moves look like when institutions are repositioning. They don't buy politely. They push, they test liquidity, they see who panics, and they scoop when the market gives them inventory. Now, I want to be careful here because I'm not telling you mining stocks are risk-free. They're not. Businesses have operational risk. Stuff can go wrong. Labor issues, energy costs, political interference, geology surprises, hedging mistakes, debt problems, management problems. Mining is not a savings account. But the reason people accept that risk is the asymmetry. When metals prices move up, the earnings power of a miner can move up faster than the metal itself. And that's why, in big cycles, the miners can outperform. They don't always, and timing matters, but that leverage is real. And here's a detail most people still forget. A lot of gold miners don't just mine gold. They also bring out silver as a byproduct. That matters more now than it did when silver was sleepy, because if the byproduct becomes valuable, it can effectively subsidize the operation. In simple terms, silver helps pay the bills while gold becomes the profit. So when I see miners getting slapped around on a day where silver is still around $90, I don't interpret that as the miners are doomed. I interpret it as the crowd hasn't adjusted their brain yet. Now here's the part most people underestimate. That ugly intraday flush is often engineered around one simple thing: liquidity. When the market is thin, it doesn't take much size to push price. And the moment price starts sliding, the machines smell blood. Stops get triggered, momentum algos lean on the move, and suddenly it looks like everyone is selling, when in reality, it's a chain reaction. That's why I keep telling you to focus on closes more than wicks. A wick is emotion. A close is intent. If you see gold rip higher, dump hard, and then still close near the top of the range, that's not the market failing. That's the market stress testing a level and finding buyers who are willing to absorb supply at prices that used to feel impossible. And silver? Silver is the king of wicks. It will throw tantrums, fake you out, and then rip again when you least expect it. If you treat silver like a calm, orderly market, it will punish you. You have to treat it like what it is, a small market that can move violently when big money decides to play. This is also why I'm not obsessed with the idea of a clean pullback. Clean pullbacks are rare in explosive phases. You're more likely to get a messy grind, a sharp shakeout, than a continuation. That's the pattern, and it's designed to make you doubt yourself. Now, let me address a narrative you're going to see more of, because the mainstream always needs a villain. The moment metals run, you start seeing articles and clips warning about massive selling pressure because of some scheduled rebalancing, some fund rotation, some calendar event, some technical reason that sounds smart enough to scare people. Maybe you've already seen it, the implication that big institutions are about to dump, and therefore you should panic, sell, or at least hesitate. Here's my take. Those stories are often exaggerated, and even when the event is real, the market usually prices it in faster than the headlines can explain it. The purpose of those narratives isn't to educate you. The purpose is to control your emotions. If you don't believe me, pay attention to the pattern. When price is rising, they tell you it's a bubble. When price dips, they tell you it's the collapse. Either way, the message is the same. Don't act, don't think, just stay passive. Meanwhile, the people who actually understand monetary history are quietly building positions and letting the noise bounce off them. And this is where we need to talk about the difference between paper price and physical reality. A futures quote can move in milliseconds. Physical supply chains can't. When demand spikes, physical dealers can run through inventory quickly. Then, the next layer of supply takes longer to arrive. That's when premiums expand. That's when spot price is down, but your local price is up. And that's when people who waited for the perfect dip realize they were watching the wrong screen. So if you're buying physical, your risk isn't only spot price goes down. Your risk is also availability gets tight and you end up paying more anyway, or waiting longer, or accepting whatever is left. This matters a lot in silver because silver is bulky, it's used industrially, and it can vanish from retail shelves faster than people expect when sentiment turns. Now I want to do something I don't do enough. I want to answer 2 viewer-style questions because I get variations of these every single week. First question, John, should I wait for a big pullback before I buy anything? My answer, If you have no exposure, waiting is a gamble. You're betting that the market will give you a gift. Sometimes it does. Often it doesn't. A smarter approach is to start small, build a position in pieces, and keep cash back for volatility. That way, you don't freeze and you don't chase. Second question. John, I'm seeing gold go up, but my friends say it's just politics and it will calm down. Are the fundamentals really that strong? My answer. Politics is a catalyst, not a foundation. The foundation is debt, deficits, and currency dilution. Politics just accelerates what the math was already forcing. So even if the headlines shift, the underlying pressure doesn't disappear. The math doesn't change because a news cycle changes. And by the way, this is also why I'm paying attention to how people are talking about alternative assets. You've probably noticed how the conversation around crypto has been shifting. When confidence is high, people chase the most speculative thing. When confidence cracks, people start asking a different question. What is real? What is liquid? And what has survived multiple monetary cycles? Gold answers that question cleanly. Silver answers it with extra volatility. And tokenization technology, whether people like it or not, can eventually make it easier to move and settle metal-backed value. That doesn't mean every token project succeeds. It means the direction of travel is toward making hard assets more usable. Now, if you're still with me, here's the cliffhanger you need to keep in your mind for the next few weeks. The moment the bond market starts to look disorderly, the conversation changes overnight. Because when bonds are stable, people can pretend the system is fine. When bonds wobble, everyone suddenly remembers that the system runs on borrowing. So if you want a simple dashboard, here it is. Watch inflation prints, but don't worship them. Watch real yields. If they roll over while inflation stays sticky, that's fuel. Watch the currency moves. A slow drift matters as much as a crash. Watch bond auctions and overseas yields. Stress travels. And watch silver relative to gold. When silver starts outperforming gold consistently, that often signals a broader participation shift. Now, one more practical note, because I don't want this channel to be theory only. If you're stacking metals and you're worried about short-term volatility, set a rule for yourself that you don't violate. For example, I buy a fixed amount on a schedule, or I buy dips of a certain size, or I allocate a percentage of income. Rules protect you from emotion. Emotion is what makes people buy high and sell low. Rules keep you calm while the market tries to hypnotize you with candles. And yes, I'm going to repeat something that matters. If you've been successful, share it. If you've built wealth, even quietly, share the principle that got you there. Was it consistency? Was it cutting expenses? Was it ignoring noise? Was it holding through boredom? Drop that in the comments. It helps someone else more than you realize. Wall Street is still mentally living in the old price regime. And when the crowd's model is wrong, price discovery eventually forces a painful update. Now, before we connect this to the macro stuff, I want to hit another important piece, the weekend effect. You've noticed it too if you've been paying attention. A lot of the biggest emotional moves happen when normal people are off guard. Overnight sessions, Sunday opens, holiday-thinned liquidity. That's where the gaps happen. And right now, we're walking into a market schedule where people will be distracted again. So if you're thinking, I'll decide later, I want you to understand the risk. Later can be more expensive. That doesn't mean you YOLO at market prices with no plan. It means you build a plan that respects how these markets move when the crowd isn't watching. Okay, now let's talk about the real driver behind this entire move, because this is where mainstream explanations start to sound like comedy. People keep trying to explain the metals rally with little neat stories. It's because of this one data point, or it's because investors are nervous today, or it's because the dollar did X this week. And those things can influence short-term moves. But the bigger trend is rooted in fundamentals that have been building for years. The key problem is simple. Governments are broke, and the math doesn't work without inflation. That statement makes people uncomfortable, so they avoid it. And then they act surprised when gold behaves like a fire alarm. Look at the inflation prints we just got. The headlines tried to spin it as good news because one metric was a hair below expectations. But the actual numbers still show inflation running well above the central bank comfort zone. Month-over-month inflation was higher than the previous month. Annualized, it's not mission accomplished. It's still hot. And then you look at producer prices at the wholesale level, and you see even more pressure. Producer prices often lead consumer prices because businesses feel cost increases first and then pass them on later. So if producer inflation is picking up, consumer inflation can follow. That's why, even if a single core number looks slightly softer, it doesn't mean the inflation story is over. It can mean the data is noisy while the underlying trend keeps grinding. Now, why does that matter for metals? Because if inflation is sticky, interest rates should logically stay high. But if rates stay high, the debt servicing cost becomes a nightmare for governments, households, and leveraged companies. So policymakers get trapped. They want to appear tough on inflation, but they also need easier money to keep the debt machine alive. That conflict is why markets get unstable. And metals love instability when the instability is rooted in trust. Now layer on something most people aren't watching: foreign bond stress. Japan's government bond yields have been rising. That might sound like a niche story, but it's not. Japan has been one of the world's anchors for low yields for decades. When that anchor slips, the pressure ripples outward. Higher yields in Japan can influence capital flows. Investors start asking, why take currency risk elsewhere if domestic yields are more attractive? And that can force adjustments across global bond markets. If global yields rise, it becomes harder for heavily indebted governments to keep borrowing cheaply. That's not a theoretical risk, that's a mechanical risk. And when sovereign debt starts to feel shaky, gold doesn't need a sales pitch. Gold becomes the default hedge for people who don't want to pretend everything is fine. This is why I keep saying, gold and silver are acting like early warning signals. They move before the official crisis is admitted. They move while the headlines still say, soft landing. They move while people argue on TV about whether everything is contained. If you remember 2007 and the early signs of the last financial crisis, you remember how it went. Something broke first. People laughed. Then more things broke. Then suddenly everyone acted like it was obvious. That's how this works. Now, let's add the political layer, because politics is basically a volatility machine right now. When leaders throw around extreme ideas, massive spending, dramatic interventions, big promises with no funding plan, the world listens and markets react. And even when those policies don't happen exactly as announced, the signal still matters. The signal is, we will do whatever it takes. Whenever you hear whatever it takes, you should translate it as, more currency units will be created. That's bullish for real assets and bearish for purchasing power. Now, I'm not telling you the dollar collapses tomorrow morning. It doesn't have to collapse instantly to lose value. It can weaken gradually while inflation chips away at what your money buys. A currency crisis isn't always one dramatic day. Sometimes it's a slow bleed that people don't notice until groceries, rent, and insurance feel like a punch in the face. Now, there's another angle here that people keep missing: trade and currency competition. When a country runs persistent deficits, it has to finance them. That financing often depends on foreign confidence. If foreign confidence fades, financing becomes harder or more expensive. And that's when bond yields rise, and that's when central banks face the ugly choice: let rates spike and trigger a recession, or intervene and risk more inflation. Again, trapped. And metals tend to do well when policymakers are trapped. Now, let me address the question I know is coming, because I can already see it in the comments before you type it. John, what about the sell-offs? What if this is the top? Here's my answer. The sell-offs matter, but the context matters more. A top usually comes with euphoria, not disbelief. A top usually comes when your barber is giving you price targets. A top usually comes when people are bragging, not hesitating. Right now, most people are still acting like this move is temporary. They still think it's going to go back to normal. They're still waiting for a magical dip. That's not top psychology. That's early cycle psychology. And you can see it in behavior. Even with metals at record highs, it's not like the entire public is stampeding into physical metal. It's not mania. It's still skepticism. That's why I keep hammering this point. The rally can be loud in price, but quiet in public participation. And that combination can persist longer than people expect. Now, let's switch gears for a second and talk about what you should do with information like this, without turning it into reckless decision-making. First, stop trying to be perfect. The perfect entry is a fantasy. In real markets, you either get positioned with discipline or you get positioned with regret. Second, think in layers. Instead of all in or all out, think in tranches. Build exposure, rebalance, protect downside where appropriate, and don't let one red day shake you out of a long-term thesis. Third, separate store of value behavior from speculation behavior. Physical metal is a different animal than mining equities. One is closer to monetary insurance. The other is a business bet with leverage. Don't confuse them. And don't size them the same way unless you understand the risk. Fourth, watch the premiums. If supply tightens, premiums on coins and bars can rise even if spot dips. That's why some people get confused. They see a lower paper price but a higher retail price. That's not a conspiracy. That's supply and demand at the physical level. Now, this next part is important, and it's also where I want to politely ask for your help. If you're one of the viewers who's actually doing well, maybe you bought metals early, maybe you held through boring periods, maybe you've been stacking consistently. Share your success story in the comments. Seriously, not to flex, to educate. Because when people see someone like them making disciplined decisions and getting results, it helps their morale. It helps them stay steady when the market tries to shake them out. And if you're not successful yet, that's fine too. Tell us what you're struggling with. Timing, patience, conviction, budgeting, whatever it is. This community becomes powerful when people stop pretending and start sharing what's real. Now, I'm going to give you the next retention hook right here because we're about to get into the part that most people do not want to hear. If the inflation pressure builds while rate cuts remain on the table, the bond market becomes the next battlefield. And when bonds become the battlefield, the metals move can go from strong to violent. That's the part the headlines don't prepare people for, because the financial system is built on confidence in government credit. When that confidence wobbles, everything reprices. So I want you to keep an eye on the bond market, not just the metals chart. Watch yields, watch auctions, watch signs of demand weakness. Watch how officials talk when they're under pressure. And while you do that, remember something. Markets often break in places the average person isn't even watching. Now, let's make this practical again. If you're new here and you're thinking, okay, John, what should I actually do right now? Here's the non-height version. If you have zero exposure to precious metals and you believe we're entering a period of monetary stress, your priority is to get some exposure, not to nail the bottom. If you already have exposure, your priority is risk management. Don't let greed push you into reckless concentration, but don't let fear push you out of the best trend you may see in years. And if you're looking at mining equities, your priority is quality and patience. The market can misprice them for longer than you think, but when the narrative shifts, the move can be fast. Now, I want to bring back the subscription point one more time, and I promise I won't beat you over the head with it. Most of you watching still haven't subscribed. If you want these weekly wraps, plus the shorter updates, plus the deeper dives we do, hit subscribe. Our goal is 50,000 subscribers in the next 30 days, and if you're watching right now, you're already part of the community. Just make it official. And remember, the description has bonus links, including the premium WhatsApp channel and the membership link. If you want those extras, go check them. Speaking of membership, let me explain what members get, because this is important and I want to be transparent. We're offering members-only videos where a separate research team helps dig deeper into topics that require extra work. Data, reports, comparisons, the stuff that takes hours to compile and clean up. Those videos are for premium members. If you want the extra layer beyond what we can fit into a public video, membership is how you get it. One last quick reminder before we wrap. If you want the extra tools, they're sitting in the description. I've placed the premium WhatsApp channel link there, the channel membership link there, and a few bonus resources that help you track key levels without living on your screen all day. And if you decide to become a member, you're not just supporting the channel in some vague way, you're backing a process. We're building member-only videos where a separate team digs deeper, pulls data together, and delivers more researched angles you can actually use. If you learn something here, pay it forward. Share the video and help someone avoid mistakes. All right, back to the markets. One thing that stood out this week was how quickly buyers stepped in after the hits. That's a sign of demand under the surface. Not guaranteed, not magical, but meaningful. And when demand keeps appearing at higher levels, it tells you something. The market is trying to establish a new range, not return to the old one. That's what breakouts do. They climb, then they consolidate, then they climb again. Now, let's address a trap people fall into. They look at the chart, they see a big move, and they assume the move must reverse because it went up too fast. Sometimes that's true, but sometimes a fast move is the beginning of a repricing, not a blow-off. When a market has been under-owned and under-respected, it can gap upward when the marginal buyer changes. The marginal buyer is the key concept. When the buyers change, from retail curiosity to serious capital, the behavior changes. And I suspect we're in that transition phase. Not fully there yet, but moving that direction. Now, because I don't want this to be abstract, I'm going to lay out the simplest framework I can for how I think about what's happening. Step 1. Inflation is not dead. Step 2. Policymakers are incentivized to pretend it's manageable. Step 3. Debt math pushes them toward easier money. Step 4. Easier money undermines purchasing power. Step 5. Real assets respond. Gold responds first because it's the cleanest monetary hedge. Silver responds later because it's smaller, more volatile, and can move explosively when it finally catches attention. Platinum and other metals can join because investors start rotating into the whole complex. Miners lag because equity markets are slower to update narratives, especially when the mainstream still acts like metals are a weird sideshow. Then, eventually, the crowd notices, and the pricing becomes less polite. That's the path. Now, does it happen in a straight line? No. Does it happen on your schedule? No. But if you understand the path, you stop being shocked by every pullback. Now, I promised I'd keep the script punchy, so let me land the plane with the two big questions I want you to answer. Question 1. Do you think Silver's next move is going to be a slow grind higher or another sudden vertical spike that catches everyone off guard? Question 2. What's your biggest obstacle right now? Finding the courage to start, finding the patience to hold, or figuring out how to balance metals versus miners? Drop your answers in the comments. I read them, and they shape what we cover next. And again, if you're doing well, share your success story. If you've made smart moves, tell the community what worked. If you made mistakes, tell the community what you learned. That kind of honesty helps people more than any chart ever will. All right, that's it for this wrap. If you got value, subscribe, because we're pushing to 50,000 in 30 days. Check the description for bonus links, including the premium WhatsApp channel and membership. And if you want those deeper dives, remember, members-only videos are live, and our separate research team is working on topics you can't get from surface-level commentary. Take care of yourselves, take care of each other, and I'll see you in the next one.